All right, let's cut right to it. We're about to dissect exactly how capital moves when the world is on the brink. And this isn't speculation, okay? This is a data-driven breakdown of the financial playbook for global crises. So war is on the horizon. Where does your money go? Look, this is a direct question for a reason. Because in a crisis, every single financial move you make is amplified. We can forget theory. We're talking about a real-world playbook for your capital. So what's the first instinct? The common assumption? Markets crash. Total meltdown. You see the panic in the headlines. But here's the thing. That assumption is a trap. The historical data tells a completely different and, frankly, a much more surprising story. Okay, look at the hard data right here. Focus on that 12-month column. We're talking Pearl Harbor, the Cuban Missile Crisis, 9/11. The market doesn't just recover, it often thrives. Get this, on average, the S&P 500 was up 8.6% a year after these massive geopolitical events. That fact alone should completely change how you view these moments.
So, if markets don't just collapse, what's the strategic playbook? Well, it's about shifting from being reactive to being proactive. Let's break it down.
The very first move is always defensive. Always. When uncertainty spikes, capital immediately, and I mean immediately, seeks safety. This isn't some new phenomenon. It's a deeply ingrained market behavior. It's practically instinct. And that flight to safety, it's overwhelmingly concentrated in three asset classes. First, you've got gold, the ancient store of value. Second, government bonds from stable, low-risk nations. And third, a very select few currencies. We're really talking about the US dollar and the Swiss franc. These are the traditional walls you build against a financial storm. And this quote right here, it gets to the absolute core of why gold has been a cornerstone for preserving wealth for centuries. The key is that it exists outside the traditional financial system. It doesn't rely on a government's promise to pay, and it can't just be printed into oblivion. In a crisis, that independence is its most valuable feature. So the crucial point is this fundamental shift. Capital flows out of what we call risk-on assets, things like stocks and high-yield corporate debt, and it floods into risk-off assets. In that first phase of a crisis, it boils down to a binary choice. Are you seeking growth or are you seeking preservation? The market always chooses preservation first. But here's where the strategy gets really interesting, because preservation is just step one. Smart capital doesn't just hide, it repositions itself for growth, because conflict, for all its destruction, systematically reallocates a country's economic priorities. Let's see how this plays out. First, the most obvious one, aerospace and defense. Government spending surges and the order books for major contractors just swell. That triggers the second move, into energy. Conflicts disrupt supply chains, and that inevitably drives up the price of oil and gas. And third, you have the modern battlefield, cybersecurity. Our digital infrastructure is now a primary target, which makes defending it a massive national security issue. And beyond the big headlines, other sectors also see a surge. You've got shipping and logistics firms, which thrive on rising freight rates and rerouted trade. Agriculture and fertilizer become absolutely critical as food security shoots to the top of the national priority list. And of course, secure communications, everything from telecoms to satellites, become essential infrastructure for pretty much everyone. Okay, so we've covered defense and we've covered offense. Now let's put it all together into a tangible structure. What does a portfolio that's built for this environment actually look like? This is a hypothetical blueprint, and it's based on historical trends. Just notice the balance here. You've got a solid foundation of 30% in government bonds and 15% in gold for stability. Then you layer on top a solid 25% in defensive stocks. Think consumer staples, healthcare, things people need no matter what. Then comes the offensive move, 10% in energy and 10% in defense to capture that wartime growth. And finally, you always keep 10% in cash for liquidity and opportunity. And why this structure? Because the data shows it works. Across multiple conflicts, these defensive sectors have historically outperformed the broader market by an average of 8.5%. That is a significant margin of resilience and growth. But beyond any asset allocation, there's one factor that outweighs all of the others. And it's not about what you own, it's about how you behave. The single biggest mistake you can make is an emotional reaction. Panic selling, it crystallizes a temporary downturn into a permanent loss. And as that first chart we looked at proved, markets recover.
The most critical asset you have is the discipline to stick to your strategy and avoid the panic that dooms so many portfolios.
Which really leaves us with a final thought. In a world that seems to be getting more volatile by the day, is a portfolio built for a crisis simply the new blueprint for resilience in the 21st century?